AM 1220 KDOW and Money 2.0 present The Real Estate Report with Tony Mendez and Gordon Hines. Bay Area real estate and mortgage experts with over 25 years in the business. Now, with an in-depth look at this week's local and national real estate news and what it means for you. Your hosts, Tony Mendez and Gordon Hines.
Welcome in to the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Thanks for joining us this wonderful afternoon, and we are back live. And happy Thanksgiving to everybody. I hope everybody drove safely. I know it was packed out there. It's interesting, Gordon, to see how many people want to leave the Bay Area. I was one of them. I left a day early, and it was packed. And then coming back, it was packed. It was awful.
It's interesting how many people want to stay in the Bay Area. I stayed. It was packed. It was awful. It was packed here while you were gone.
With that said, this is the Real Estate Report. It's your second opinion to real estate, whether you're buying a house or you already own a house, you're looking for investment property, and so on. There's plenty to talk about today. We could talk everything about home supply increasing nationally next year, but not in the Bay Area, according to, I think this is according to Trulia. We could talk about rates, pre-qualifications during or pre-approvals. What's the difference? That's an email that we got. If you're in a cheaper home, you're in the money. That's an interesting story about how the low-end market is doing a lot better than the upper-end market. They call the lower third versus the upper third. And the lower third is screaming right now. It's doubling the year-over-year increases in appreciation right now. Pending home sales are rebounding. We really want to get this out there about the loan limits. Those have increased from Fannie Mae and Freddie Mac, and it's going to help a lot of people here in the Bay Area. We're going to talk a little bit about the panic over some weird, obscure provision in the Senate tax bill. Some other data, multifamily research for anybody who wants to talk about investment properties here in the Bay Area is for the fourth quarter of 2017 Bay Area report. Case-Shiller has the home price index, shows a year-over-year 6.2% increase in September. Another interesting story, a third of homeowners will consider moving out of California if the state and local tax deductions are eliminated. Where prices shooting up in the United States. So we have a lot to talk about today. You call the show 800-516-1220 about any of these topics, 800-516-1220, or email the show, Tony@BayAreaLoanSource.com. And Gordon, I think the story that we should just start out with is loan limits. Fannie Mae and Freddie Mac increased the conforming loan limits for the second time in as many years. Last year, the Federal Housing Finance Agency increased the maximum conforming limit to I think it was $424,100, and that's been increased up to $453,000. That's up how much percent? Like 6 point.
It's a 6.9% increase on the conforming rate, which went from $424,100 to $453,100. I always get crazy why they come up with these odd figures, $453,100. Why not round off to $454? But every year they do these things, and I'm always puzzled by it.
Well, and that also increased our what they call high balance conforming, which most people are getting if you're buying a house here in the Bay Area, or you're refinancing from $636,000 to $679,000. So that was a $43,000 increase. And these are great news for people who want to get into a Fannie Mae or Freddie Mac loan. They have better guidelines for people looking to take cash out, people who have lower credit scores or credit events, and it keeps you away from that jumbo product. And everybody's hearing about the jumbo and how the rates have come down, and they're really trying to push those products in the market. Every bank's doing it. But if you can stay in Fannie Mae, Freddie Mac, it's going to help the majority of the people. So it's really good news, Gordon.
Yeah, I mean, it's a great thing. I still believe that it should be done more precise. For example, in the contiguous United States, including the District of Columbia and Puerto Rico, the conforming loan is $453,100. That's what it's going up to. In Alaska, Guam, and Hawaii, and the Virgin Islands is $679,650. I actually believe California should be in that category with those people.
And then have the high balance even higher than that.
Yeah, because our home prices are traditionally higher than everybody across the country. So if you live in Alabama, Mississippi, your conforming loan limit is a $453,000 loan, which is not easy to compare apples to apples if you're looking at conforming loan limits for that state versus California.
Yeah, so what they do is they take the median home price and they take 150% of that, and that's how they come up with these numbers. That's why they're kind of obscure. Some of the other things that you want to pay attention to when looking, comparing a jumbo loan or a Fannie Mae, Freddie Mac loan, is the credit scores. And that's really big. The minimum credit scores for most jumbos, unless you're going to what they call a portfolio jumbo, where the rates are much higher, is 680. I don't think I've seen anything lower than 680. And then your rates are really high. But with Fannie Mae and Freddie Mac, if you can get there, the guidelines are better. The lower credit scores can still give you a decent rate. But what it really means in math is, say if you want to do a 10% down 10% down purchase on a high balance with a high balance loan, it gives you how much, Gordon?
$755,166 with 10% down brings you right to the limit of $679,660. If you were looking on a conforming limit, you're looking at $453,100, which gives you $715,400. $715,400. 5% down. 10% down is $755. Going back to the conforming loan limit, if you want to do a 3% Fannie Mae, any of those programs, the Home Ready or the low income budget programs for different neighborhoods.
That's that 1% down.
That's
product,
1%
right?
down. It's $467,800, which is a darn good deal with 3% down. Still brings you in conforming at $453,100. That's a good deal. The only thing that we got to figure now is FHA typically follows. I think normally around February, FHA announces their new loan limits. Sometimes they do run synonymous with the Fannie Mae and Freddie Mac. Sometimes they don't. So we're hoping that FHA follows the same suit, and their also minimum loan limit goes to $453,100. That's what we're hoping for.
Yeah, it's good news. And if you want to run some scenarios, you can always email us, Tony@BayAreaLoanSource.com. If you want to call the show, it's 800-516-1220, 800-516-1220. So one of the other stories that I found pretty interesting was some of the stats that come out about what they call the lower third of the market compared to the upper third of the market. And of course, affordability plays into this, and inventory plays into this. There's not a lot of inventory in the lower third, where there's more in the upper third, especially when you have home builders that are focusing on the higher dollar types of properties. The home prices in the low end of the market are rising twice the pace as those in the high end. So that's why they're saying if you want a cheaper home, you're in the money. Prices have now recovered 46% from the trough of the housing crash back in the early 2012, and are nearly 6% higher than the peak of prices in 2006. It's really 2007. During the recession, builders dropped production by more than half of their normal pace, and inventory and affordability is the key to this phenomenon. The shortage is worse at the low end of the market, which is why prices at their tier are rising twice the pace. Not only that, a lot of you talk about the lower end, Gordon. We just talked about conforming limits, and you can do those lower down payments. You don't have to go to FHA. Most of the time, you don't have to use a jumbo, and you can do 3% down with up to 460 something thousand. And that's enticing. And instead of looking at something at $600,000-$700,000, you're borderline in a jumbo loan. And the mortgage insurance has actually gotten cheaper over the last couple of years. So, and there's also something called
options. There are a lot more options to it. Mortgage insurance. There's many more. There's single pay. There's level pay. There's 12-month pay. There's no mortgage insurance, where you can factor the mortgage insurance into your rate, called lender pay. So many different options of mortgage insurance has also helped.
Right. So this kind of goes hand in hand with when you have, and it's part of the recovery too. We're looking at the Federal Housing Finance Agency doing their part, and in the lower end at least. A survey done by Zillow shows a difference in home price appreciation in different markets around the area. The high end, like I said, is defined as the top third, and the low end is the bottom third. Nationally,
did they give you a number? Bottom third, that doesn't mean a whole lot to me. Did they tell you what a number is?
No, it didn't. Okay. It's just nationally, though, the high end home price year over year is 3.7%. The low end is 8.4%. Places like Los Angeles, 5.6% in the low end. This is year over year. Home appreciation. On the low end, it's 7.6%, and you get places like San Francisco, 5.2% in the high end and 9.1% in the upper end. I'm sorry, the low end. So it's affordability here, Gordon, and it's inventory. Inventory, you look at places like Oakland and a lot of parts of the East Bay, and then even further out, where home prices are still trying to catch up to those big limits, or those big median prices that we see in the peninsula and in San Jose and in San Francisco and a lot of parts of the Alameda County and Contra Costa. And they're still trying to catch up, but then we have these really good loan limits that are helping people get into these properties, and it's pushing those prices up faster and faster and faster. And for a while there was some availability there, and now the inventory is starting to squeeze those higher the multiple offers, the over asking prices, and driving that price up. Do you see opportunities here, or do you just see this as a place where people are just saying, I want to afford it? Because we're going to hit a story not too long from now about how people just don't want to sell, and that really does play in it because of things like SALT, the deduction that may go away of the state and local taxes. And people are like, I may not be able to afford to move because there's not another house around the corner for me to buy, and that's limiting our inventory as well. So is this an investment idea, or is this just people looking for homes?
Well, there's a number. You said a number of things. I think when you look at the economics of the numbers, I think, of course, the low end is going to have a higher percentage increase than the high end because there's more qualified buyers in the low end and the high end. You mentioned Oakland versus the Peninsula. I call them the fallout cities. Like, all right, you can even start to look at Stockton and Tracy. As affordability starts to go up, to get affordable housing, you have to venture further away from your base. So people now are revisiting Stockton and Tracy, and those places are making great appreciation stride because when you look at it, they've been overlooked for so long. They're actually true affordable housing. Matter of fact, I'm doing a transaction down in Newman. The young lady is a postal worker here in Oakland. Newman is about an hour and 15-minute commute from Oakland. And the reason why she's venturing down into Newman, she's got a 5-bedroom, 3-bath. She's got kids who want to get them out of the neighborhood and into a house. This house has a pool upstairs, downstairs. It has solar panels, the whole works. So affordable housing, she was looking at $353,000 here in Oakland. There was nothing available. She's probably looking at a 1-bedroom, 1-bath condominium or a 2-bedroom, 1-bath small.
Or you go to
house.
Newman and you get for $400,000 or $500,000
for $350,000.
Yeah.
So when you look at it comparatively, it's a great deal. The only thing is that you have to like I told you have to factor in the cost of the commute, the time of the commute, because that all ends up in a number. I think once you factor those, then she's still coming out ahead.
According to Zillow, the supply in the high end of the market is much greater, and the supply in the middle of the market, which is where most of the home buyers are targeting, is growing. But there's not much hope for the supply in the low end. The past 2 months have shown promising signs of life from builders that have difficulty meeting this intense demand and facing rising land and lumber and labor prices. But it's going to take a lot more than 2 good months of full erases of the housing deficit we're facing after years of home building, according to, I'm going to say this name wrong, Svenja Gudell, chief economist at Zillow. So it'll be interesting. You know, we just briefly talked about how people are holding on their houses. You know, Prop 13 is one of the reasons. Another is, you know, can you upgrade or downsize? And a lot of people can't because they're, you know, qualification issues in the house around the corner or in the better neighborhood or in a smaller site is you just don't qualify for it, or it's not there at all. And that's why we're seeing this run up. Another part of angle to look at too is investors. During our, you know, the recovery, a lot of investors came and bought properties in with, you know, limited inventory for purchasing. We had some trouble. A lot of people were forced out of their home with some sort of credit issue, foreclosure, bankruptcy, short sale, things like that. And we didn't have lending really pick up, and they didn't adopt any kind of programs that really made sense. And people were doing loan modifications, things like that, and really destroying their credit. And these people were left renting, and investors were just buying, and they're going to hold on these properties, Gordon. I know you own a lot of investment properties, and you're going to hold on. The rents are high, and they're going to continue like this, and that inventory isn't going to be there anytime soon.
There's a balance. Of course, I don't know where the fulcrum of the balance is, but there's a balance. I think a lot of investors that buy single-family homes, a lot of times the equity is so great. Single-family homes work as great houses to resell because there's a great profit potential. Of course, the multifamily units are where you get the strong rental increase and the rental income, and you can really help build your portfolio with that rental income.
If you have any investing questions, you can always call the show, 800-516-1220, or shoot us an email, Tony@BayAreaLoanSource.com or Gordon@BayAreaLoanSource.com. We'll come back right after this break here on AM 1220 KDOW. This is Tony Mendez and Gordon Hines in the Real Estate Report.
This is Money 2.0 on AM 1220 KDOW.
Come with me now. Come with me now.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
You can always call the show, 800-516-1220, 800-516-1220. If you thought your mortgage was high and you're having trouble affording it, Jay-Z and Beyonce just bought a $88 million property with 40% down, gives them a $52 million mortgage. It's 2 acres in Bel Air. I ran the figures at just, you know, average interest rate. They're paying $263,000 a month on their mortgage. And their taxes every month is $91,000. That's $354,476 a month. And you have to make $9.9 million a year in order to qualify for that at a max debt ratio. That's incredible.
Wow. Some guys have all the fun. I asked you earlier if there's somebody you'd like to swap places with. I'd like to swap places with Jay-Z then if he's going to spend $263,000 a month on a house note.
Jeez. So I think that's a pretty big number. Johnny Carson, their estate is selling that Malibu property. I think that was $61 million. A little bit cheaper. It's right on the water. It's beautiful. kind of like that property too. But we're talking huge numbers. But interest rates do help. Interest rates right now, 30-year fixed at 3.9%, according to Freddie Mac weekly survey. 15-year at 3.3%, and the 5-year ARM at 3.32%. All great rates. Gives the people the opportunity to, and those are Fannie Mae, Freddie Mac, and we just talked briefly about how Fannie Mae and Freddie Mac just increased their loan limits. I think it's a powerful tool that they're trying to use in places like the Bay Area. It doesn't quite reach, let's say, the median home price. I think I saw a chart earlier, $800,000 for Alameda County and 20% down. That's a $640,000 loan. You're meeting it now, and so that really does help. If you have a good credit score and you have that 20% down, and it's a single family residence, you're getting some good rates out there, and that's why they are doing this, and it's helping people in these high dollar areas.
Well, that if you think about it, Tony, 3.9% on a standard 30-year fix. If you look back, I did last week. I talked about rates where they were a year before. They weren't much far off. If you look at all the turmoil we went through, 2011, 12, 13, 14. And then you look at all the gravy that we've been seeing in the last 4 years, 2015, 2016, 2017, stock market hitting all-time highs, unemployment numbers hitting all-time lows.
Home prices hitting all-time highs.
GDP growing at 3%, we haven't seen in
unemployment
the last 10 years. So when you look at that 3.9% is a darn good deal if you can finance a property up to $700,000-$800,000 at a 3.9% rate. That's a great deal for the American public.
It's certainly one of the things driving people to buy houses, and why we have such high demand. We're still looking for the answer of why the inventory is so low and why builders are focusing on the higher end and not the lower affordable. We know California is struggling with that. There's no quick answer. There's no really easy answer. We don't have the right infrastructure for it.
The builders focus on that because it's more profit. You figure
we know why they're doing that.
Change. Your fixed cost is going to change, maybe nominal, but so you build high-end homes, you put in more bells and whistles. That's what a lot of builders are doing now, adding wine bars and jacuzzi tubs and all kinds of fancy bells and whistles to help propel the price of that house higher, which, of course, to make more profit from. That's exactly why.
That kind of plays into this whole another story here. Home Depot shares hit all-time high as the housing momentum swells. Company advances mobile initiatives. You look at a company like Home Depot, you look at Lowe's, you look at all the the construction industry as a whole, and you see them just booming. Home Depot is out actively pushing and looking for salesmen to sell what they do outside sales, and that's because they know that that's where the business is, and because people are saying, I hate using this term where I say I'm locked into my house. I'm forced to stay in my house, but a lot of people are, and they're going to try to make the best of what they have, and they're going to do some home improvement. They're going to do the bells and whistles, and then maybe add a little bit to their house. And in fact, we did have an email.
I know we don't like to toot our horn, but we talked about this. We mentioned that Home Depot and Lowe's, those companies are going to do well because of the behind every dark cloud is a silver lining theory. The floods in Houston, the fires here in California, the tornadoes and the earthquakes and everything else in the back east, and the hurricanes in Florida. I mean, these companies have really been able to capitalize on these natural disasters, and they're making a lot of profit. And you can see it in their stock price.
We totally see it, and Home Depot is really profiting on that. I was looking for that email. It was somebody who said, it's the square footage. There's a price per square foot. I think this is just an outstanding chart here. San Francisco condos, $1,068 per square foot. Central San Mateo is $972, $911 for Southern Marin. San Jose, $623. Northern Marin, $573. Oakland, $521 per square foot. And we had a question about adding square footage to your house. A couple of years ago when we were asking this question, most of the realtors said, it's not a really good idea. You're going to get dollar for dollar, but we're going to talk about this when we come back. It doesn't make sense to add square footage to your house and try to sell it and get more money. We'll come right back after this break here on AM 1220. I'm Tony Mendez. That's Gordon Hines. You can call the show 800-516-1220.
This is Money 2.0 on AM 1220 KDOW.
Tried to clear my empty head of those words that were never said. Sat alone in a hood, my drone and I, when the wind would change direction.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Would you build on your house if you're selling your house, Gordon? And a lot of people here are looking for money. And let's say you have a $900,000 house. You live in one of those areas. We just went through a list of. Let's say you live in Southern Marin, okay, and their average per square foot is 911, okay, and let's say you can add 500 square feet, okay, another $45,000 to your property, maybe and add that room, and now instead of a 3 and 2, it's a 4 and 2 or 2 and 2. Now it's a 3 and 2, and you're talking to your realtor, and they're saying, "Oh yeah, you could sell this house for another $50,000." And would you? And you just told me kind of off air. You said you wouldn't do it because it's just a hassle. But in the way I see it is that's money. What if you can increase the profit on the property, and the realtor's making more money, but you made more money, and you're paying the realtor that money, and now you're walking away with a little bit more. Does that make sense?
Well,
I mean, I'm getting the question often enough that there's people out there thinking about it.
I've got two answers. The first answer, if you look at it from an economic standpoint, of course, if you add to the house, you're going to make more money. The medium-sized home in 2000 was 1,875 square feet. The average size home now being built is 2,600 square feet. If you look at all the models that the builders are building, they're building bigger homes because the bigger homes brings more money. So that's one. The problem with that is it's hard to really renovate. If you've done any renovation, it's hard to renovate and do a major remodel into a home and still live there. It can cause you so much turmoil, so much stress between the family members. So from the economics, yes, but from the practical standpoint, I probably wouldn't risk it.
First of all, you have to be in a kind of zoning friendly city or county. So I can see both ways working. But again, we're getting the question often enough where I think people are considering it. Maybe it could be a garage conversion, and you already have a off-street parking, and the garage is already built, and you're all of a sudden turning it into another room, maybe, and definitely permitted. There's something you have to be really careful of. Unfortunately, we run into a lot of people who are either buying or refinancing a property where there's unpermitted additions, and those are pretty tough.
And like you just mentioned something too, also some cities are more user friendly when it comes to building, remodeling the permit process. A lot more easier, a lot more simplified, a lot less costly. If you're living in one of those cities, great. If you're not living in one of those user-friendly permit cities, and you got to jump through so many hoops and so much red tape to get that permit and get those inspections and get those sign-offs, then it wouldn't be worth it. So you got to look at all the factors when you come to making that decision, because not all money is good money, as I always like to say.
You can always call the show, 800-516-1220 to join the conversation, 800-516-1220. Case-Shiller Home Price Index shows a year-over-year 6.2 increase in September. They merged July, August, and September together. This release includes prices from 20 individual cities, 2 composite indices for 10 cities and 20 cities, and the monthly national index. This is up from 5.9% the previous month. We're getting conflicting reports here that home prices are going up at this pace. National Association of Realtors, they show it even, and then there's some other ones out there like Realtor.com. But Seattle, Las Vegas, San Diego, we reported the highest year-over-year gains among the 20 cities in September. Seattle led the way with 12.9% year-over-year prices, followed by Vegas at 9% year-over-year, and San Diego with 8.2%. It's fascinating to see how people are gravitating towards Seattle. I don't know if you've ever been there. It's like the weather it is right now, but it's like that all the time, where it always feels like it's going to rain at any moment. But those sunny days are just absolutely gorgeous. But what I remember the most about Seattle is just traffic. You thought traffic was bad here. Seattle was just a nightmare, and then you got to take ferries and all over the place.
That's part.
I'm not saying
that's
I
part
don't.
of the intriguement of the city. You got the weather,
I was just wondering how long
the
it takes.
waterways. You have a lot of little islands up there. The weather's cooler. It's a much different climate. So, once again, there are people that wouldn't trade the desert for Seattle. People live in Arizona and New Mexico and those type of places. You can give them a free house in Seattle. So everybody has their own flavor. And I think, the great thing about it, Tony, is great places to live here on the West Coast, all along the Western Seaboard. All those are great cities, in my opinion.
In fact, I want to talk about this when we come back. There's the next American ski towns. There's quite a bit of cities on this list. I think that's another great little story of where people are gravitating towards. This is Tony Mendez and Gordon Hines with the Real Estate Report. You can always email the show, Tony@BayAreaLoanSource.com.
This is Money 2.0 on AM 1220 KDOW.
Welcome back into the Real Estate Report. I'm Tony Mendez.
And I'm Gordon Hines.
Where are prices shooting up in the most in the United States, the West and the East, basically near the oceans. Seattle is leading the way. Just kind of talking about that. Vegas, Portland, Denver, San Francisco, San Diego, all posted annual increases of 7% or more as a result of their strong economies and limited number of homes on the market. Price gains in Boston, Dallas, and Tampa, Florida also exceeded the 7% threshold. Again, a different number that we're seeing from Case-Shiller. I kind of like the Case-Shiller one because, again, it's all trends. If you watch the same indice over and over and over, you're going to get a trend, and that's really what we're looking for. And they're still growing. It's low inventory. What do you want to talk about next? A third of home buyers will consider moving to another state if SALT deductions are eliminated. SALT stands for state and local taxes, according to Redfin survey, as their uncertainty of tax reform bill is looming over the customers' minds. One of the provisions of the tax bill is the reduction or complete removal of deductions called SALT, state and local taxes, depending on if the House or Senate passes the bill. Either way, it's already having an effect on homeowners and potential buyers. Of the nearly 900 home buyers who are active on Redfin to find out whether they still hypothetically the elimination of such local tax deductions would be enough to cause those people to reconsider or relocate. Among those surveys who said they are under contract or plan to buy a home within the next coming year, 42% said they would not consider moving, but 1/3 of respondents said they would consider a move, with 6% say they would absolutely move if this passed, with 11% saying they would seriously consider. So about 17% say would seriously consider or absolutely move if this passes. Gordon, what do you think?
Well, I think anytime there's change, you get what they call the panic attack. You get people that are looking to make decisions quickly. They're confused. And then once I think the dust settles and the tax plan goes into effect and they see that the big thing is not as big as they thought, you start to see people kind of settle down and kind of redefine their thoughts and kind of stay put. That's what I think.
Yes, I would considerably move. Nationally, it's 11.4%, 14.2% if it's California. Yes, I would move. I would consider moving. 16% nationally, 17.2% for California. I would absolutely move at 6% for California, and so on. So we really do see these numbers. But is that 6% of the people who say they'd absolutely move? And those are buyers. Will it really change anything about the kind of buyer and demand that we have right now and affect home prices?
It's not enough. I don't think it's enough. I mean, by itself, the one event by itself is not enough. If the event, of course, starts to compile, I think
like interest rates
changes. I think then you'll see that factor in. But you got to look at jobs. I mean, everybody want to move, but if you have a great job and it's not mobile, and you can't move, you're going to stay and put. There's a lot of different factors are going to go into that formula. I think the first thing is the knee-jerk reaction. You hear all this thing coming down. You're not going to be able to do this. You're not going to do that. You're not going to be able to write this off. And then once the dust settles, I think a lot of people kind of reformulate their thought process and they kind of stay put.
Another interesting provision in the Senate tax bill is they're including a change in the way that mortgage servicers pay their taxes. Under the current law, lenders pay taxes on the servicing as they receive their cash. They get those mortgage payments and so on. Under the Senate bill, according to the Mortgage Bankers Association and other groups, lenders would have to pay their taxes up front based on the projected income of their servicing. It's a mismatch between when the income is actually taxed and when they actually receive the money could lead lenders to withdraw from servicing altogether, the trade group says. The change, according to David Stern, MBA president, will cause servicers to exit the business completely. In other words, they won't be able to afford the new tax structure and leave the servicing business. Have you heard about this?
Well, I've heard about it.
Imagine you're paying your taxes on your income before you even get it.
Yeah, I mean, once again, there's all kinds of thought processes out there. I think it doesn't sound too practical. Of course, why would I be in the servicing business if I have to advance money? It's like you're managing a property, and I've got to advance monies to the owners and then wait till I collect the rent from the tenant to reimburse myself. That's not a very good business model, not a good business plan. So, of course, you're going to see servicing. Of course, you'll find servicing companies closing. You'll find the cost of servicing increase.
That was the other question. Is it going to get passed on to the buyer?
Everything gets passed on to consumers through some form of trickle-down method. They'll find a way to pass it on. Nothing goes for free in our business.
So it looks like overall, the median to upper-end homeowner, home buyer, especially places like California, are going to get stuck with either the the elimination or the reduction of the mortgage interest deduction, and or the elimination or the cap of $10,000 on their state and local taxes. So a lot of people maybe wanted to see how this plays out. Right now, things are still busy. Every realtor I've talked to said that their demand is still pretty high, and I know your demand, the stuff that you do, is pretty high as well. And we've only had one client that I know of that's kind of backed out and said, I'm going to wait till January and see how this plays out.
Yeah, I mean, what I'm seeing as we talk over the last couple of weeks, I'm seeing a lot of more inventory in the market. I'm on these lists where every day there's a new listing. I get emailed, and I'm seeing. I watch prices. I see where prices are, even though there are more coming, but the prices are steadily increasing. I've seen in the last couple of weeks, I've seen a lot of repricing, which is really a price reduction in the current inventory that they have. So a lot of things. The market's always changing. The market works good on change. It never works well on stagnation, either up or down. So it's always a good sign. If you watch the stock market, the market goes up 3% today and down 2% tomorrow, and it's always good for change. I think that's what makes a healthy market. A market that's changed is always constantly moving.
Next American ski towns. Oh, call the show 800-516-1220. A lot of people, this is a perfect time to talk about this. The snow is starting to fall. It's getting cold. People want to hit the slopes. Do you want to, if you're thinking about moving, you're one of these people who say, I'm going to leave the state. Where are you going to go if you like skiing? Some of the traditional ski towns are no longer affordable options for most skiers, and these satellite ski communities are now the new dream. Reno tops the list. Population 245,000, median home price 326. That's wrong. It's really 380 something thousand. But Reno's pretty nice, and then you go to places like, it's a very long report, Waterbury, Vermont. I don't think a lot of people are going to move to Vermont. But if you like skiing, that's a good place. Spokane, Washington, 215,000 population, median home price 175,000. I imagine, Gordon, as people in California are starting to realize that they have a lot of gain on their property, and we have, we're going to have some people leave the state, take some equity. They're going to go and want to find some retirement homes or some vacation homes, and want to retire near these ski resorts and other kind of locations like Santa Fe, New Mexico. 85,000 population, median home price 310. We might look at this as an investment angle at some point. We'll come back after this break here on AM 1220 KDOW. I'm Tony Mendez.
And I'm Gordon Hines.
You can always email the show, Tony@BayAreaLoanSource.com, or call the show, 800-516-1220. We'll be right back.
Is Money 2.0 on AM 1220 KDOW.
I'm going back to my roots another day, another door, another high, another low.
Welcome back into the Real Estate Report. I am Tony Mendez.
And I'm Gordon Hines.
Thank you for joining us. You can always go to our website, BayAreaLoanSource.com. You can join our newsletter. You can also call the show, 800-516-1220. Email us any scenarios. We love scenarios. We did get an email, and I get this email often. It's really not the email. It's more of the scenario where somebody's walking around with a pre-qualification, not a pre-approval. And we just kind of want to throw that out there again, that there's a huge difference between somebody who calls you on the phone, or you are calling a lender on the phone, telling them how much money you make, what your credit score is, what your down payment is, if you're doing a refinance, how much your equity is, what your value is, and they go, yeah, you're qualified. That's a pre-qual. And unfortunately, a lot of people take that pre-qual, Gordon, and they think that that's their ticket to go buy a house. Well, if I was a realtor, I wouldn't touch somebody who just say, oh, yeah, I already talked to my lender, I'm good to go. You need a pre-approval letter. There's a big difference. You're actually verifying credit, you're verifying down payment, or you're looking at the property, setting some sort of estimated value. If it's close, you kind of prep them on what's going to happen with the appraisal. You really don't know until you get the appraisal, but there's a big difference between the two. And it's unfortunate that there are still people that are going out there, and you can even go beyond a pre-approval. You can get what they call a to be determined, TBD approval, where you're actually submitting a real scenario, your income, your assets, your credit score, your down payment, all of that to the lender, and you're walking literally around with a piece of paper that all you have to do is fill in the address. And we are doing those more and more often, and it's so powerful when you're going into an offer and you're giving somebody what they call a to be determined approval. It doesn't cost you a dime until you do the appraisal. Well, at least with us. I mean, I know there's lenders, Gordon, out there that are still charging $500 for application fee, and they go, oh, yeah, we'll pay you back at the end of the transaction. Meanwhile, you're locked in and you can't get that thing back until if you decide to move, and it's something that just still irks me. But it's still out there, Gordon. These people walking around with pre-quals, and they need something a little bit stronger than that.
Yeah, I think the different things, different scenarios, of course, work under different circumstance. The larger loans, of course, I think the pre-approvals with the formal presentation lender, verification of income assets, because some of those big loans have large credit score requirements, and they also have reserve requirements. Yeah. So you have to have those reserves, because it can be a deal breaker if you don't have the 12 months reserves on a $3,000 a month payment. That's $36,000 you have to you can show the reserve. You don't have to use it, but those are the important things that you kind of get buttoned down, and you don't get your pre-approval burnt or closed or declined after you went through the whole process. Now the borrower's into a purchase contract.
You just brought up another really good point about why Fannie Mae and Freddie Mac's loan limits, which were just increased, loan limit for conforming limits up to $453, but the high balance conforming, which is still Fannie Mae, Freddie Mac, it's just the rate's a little bit different. That's up to $679,000. But they don't, if you can avoid that jumbo and you don't have those 12 months PITI, which is principal, interest, tax, insurance reserves, and in some cases that can be, $40,000, $50,000, and you don't have it. Yeah. Fannie Mae, Freddie Mac, you don't require those kind of asset requirements unless you have rental property.
I have a deal breaker situation right now where there's a client. He's looking to refinance. He just bought a new house down in Stockton, and he has a duplex here in Oakland. He was looking to take some cash out because he had to spend a lot of his money to get a new house. He has good credit, good rental income. Everything works, except he doesn't have the 12 months PITI reserve, which is like $15,000 to show that he has. So therefore, the transaction can't close. So those pitfalls can be very, very valid. So you got to make sure you have them covered.
So we encourage people to reevaluate your loan situations if you're close to that high balance limit, that the old one. Maybe this new balance limit will help you get into a refinance, or at least check it out. We're here to help you with your questions. You can always email me at Tony@BayAreaLoanSource.com or Gordon at BayAreaLoanSource.com. You can always go to our website, BayAreaLoanSource.com. We appreciate you listening today. Thanks for joining us, Gordon.
Welcome back. We'll see you next week. Thanks for tuning in.
Thanks for listening. This is Tony Mendez and Gordon Hines of the Real Estate Report here on KDOW.
Credit